Picture two people sitting across from each other at a dinner table in 2019. One of them says Bitcoin is going to $100,000. The other one laughs. Not a polite laugh, the kind that says, "You have lost your mind." That first person was right. And almost nobody at that table believed them until after it already happened. Now, here we are in 2026, and there is a new prediction on the table. This one is bigger, much bigger. And the same people who laughed in 2019 are doing the exact same thing again. Which raises a question worth sitting with. What if the laugh is the wrong reaction? What if the prediction that sounds the most absurd is once again the one that turns out to be true? Because if it is, the implications do not just affect the people who already own Bitcoin. They affect how money works, how governments store value, and what the next 20 years of wealth building actually looks like.
That is the whole video. And by the end of it, you will understand why serious institutions, the kind that do not gamble with reputations, are quietly treating this prediction not as a fantasy, but as a base case. Let's start with where Bitcoin actually stands right now, because the current picture tells you more than any price chart. Something shifted in 2024 that most people still have not fully absorbed. The United States Securities and Exchange Commission approved spot Bitcoin ETFs. That does not sound dramatic until you understand what it actually means. For the first time, the largest pension funds, university endowments, sovereign wealth funds, and Wall Street banks could put client money directly into Bitcoin through the same regulated wrapper they use for stocks and bonds. The door that had been locked for a decade swung open in a single afternoon. What walked through that door was staggering. BlackRock's Bitcoin ETF pulled in over $62 billion in inflows in roughly a year. That is not retail investors buying out of excitement. That is institutions making deliberate, strategic allocations.
Harvard increased its Bitcoin position. Wells Fargo expanded exposure. JP Morgan followed. By late 2025, Bitcoin ETFs were collectively holding nearly 6.5% of the entire Bitcoin supply that will ever exist. Think about that. 6.5% of a permanently fixed supply, locked inside institutional products, growing every quarter. And the supply itself never grows. There will only ever be 21 million Bitcoin. Ever. That combination, surging institutional demand, meeting a supply that cannot respond, is the engine underneath the prediction we are about to talk about.
In March 2025, something happened that would have seemed like science fiction 5 years earlier. President Trump signed an executive order establishing the United States Strategic Bitcoin Reserve. The U.S. government, which had spent years auctioning off seized Bitcoin like confiscated furniture, suddenly stopped selling it. The order directed the Treasury to consolidate all government-held Bitcoin into a single reserve and prohibited any future sales. The United States government currently holds approximately 328,000 Bitcoin, worth roughly $25 billion at recent prices, and it is now officially a reserve asset. Not a speculative holding, not a seized asset waiting for auction, a reserve, the same category as gold.
Here is why that matters enormously. When the United States puts something in a reserve, other nations pay attention. The Czech Republic began studying Bitcoin reserves. Sweden's parliament submitted a formal inquiry to its central bank. Switzerland is tracking a citizen campaign that could trigger the world's first national referendum on Bitcoin as a central bank reserve asset. New Hampshire became the first U.S. state to pass a strategic Bitcoin reserve into law. More than a dozen other states introduced similar bills. The quiet shift happening at the government level is exactly what the loudest Bitcoin prediction of 2026 is built on. Once sovereign nations start competing to accumulate a fixed supply, the math changes in a way that is very hard to argue with.
So what is the prediction? Several major institutions now have a target of $150,000 for Bitcoin in 2026. Standard Chartered, Bernstein, Citibank, JP Morgan has an even higher target, close to $170,000. Goldman Sachs has floated scenarios approaching $200,000. These are not fringe voices. These are the firms that manage the retirement savings of millions of people. But those are the near-term calls. The prediction that changes everything is further out. ARK Invest's Cathie Wood has laid out a case for Bitcoin reaching $1.5 million by 2030. Not a dream scenario,
A base case built on institutional adoption, supply scarcity, and even a small percentage of global wealth treating Bitcoin the way it currently treats gold. The gold market today is worth roughly $17 trillion. Bitcoin's total market cap would need to reach roughly half that size to hit $1 million per coin. That sounds impossible until you remember that Bitcoin's total supply is fixed and gold's is not. Every year, miners pull more gold out of the ground. Bitcoin's supply growth is scheduled to slow down and eventually stop entirely. The next scheduled halving, the event that cuts the rate of new Bitcoin creation in half, arrived in 2024. History shows that within 12 to 18 months of every halving, Bitcoin has reached a new all-time high. It did it again in October 2025, touching $126,000.
The people making the long-range predictions are not ignoring the volatility or the risk. They are looking at the structural forces underneath and concluding that the direction is not really in question, only the timing is. Here is the detail that almost no one talks about, and it is the one that reframes this from speculation to something more structural. At its current price, Bitcoin represents roughly 6% of gold's total market value. 6%. If institutional investors simply decide to treat Bitcoin as a partial substitute for gold, not a replacement, just a partial substitute, and allocate even 2% of the roughly $200 trillion in global investable assets, the math produces a Bitcoin price well above $1 million. 2%. Not a dramatic shift, not a revolution, just a modest reallocation from an old store of value to a newer one.
The faucet analogy from basic finance applies cleanly here. Bitcoin's supply is a sealed tank. The amount in the tank never grows past 21 million. What changes is how many people are trying to fill their cup from it. Right now, institutions are lined up, governments are lined up, and the tank is not getting any bigger. None of this means the path is smooth. Bitcoin fell more than 30% from its October 2025 peak in the months that followed. Some analysts see a further consolidation, possibly down to $60,000 or $65,000 before the next major leg higher. Peter Brandt, one of the most respected technical traders alive, assigns a 25% probability to a severe pullback. Fidelity has called 2026 a potential dormant year. Morgan Stanley has warned that the 4-year cycle may be entering its winter phase. The honest version of this story includes the fact that Bitcoin has experienced multiple declines of 70 to 80% in its history. Anyone who tells you the upside is guaranteed is selling you something.
What the bearish case does not explain away is the structural shift that happened beneath the price. The ETFs are real. The government reserve is real. The institutional allocations are real and growing. Those are not sentiment. They are infrastructure. And infrastructure tends to be stickier than price. So here is what all of this actually means for an ordinary person watching this video. The prediction is not really about a number on a screen. It is about what happens when a fixed supply asset collides with an entirely new class of buyers who have never had access to it before. It is about what happens when governments start competing for a resource they cannot print, mine faster, or manufacture. It is about what happens when the financial world's largest institutions spend years building the pipes to deliver Bitcoin to their clients and then turn those pipes on. The person who understood in 2019 what was coming did not need to be a genius. They just needed to take seriously the things that the crowd was still laughing at. The crowd is still laughing at the bigger number. They laughed at $10,000. They laughed at $100,000. The question worth asking quietly to yourself is whether the laugh is the right reaction this time.
The prediction might be wrong. Markets are not guarantees, and no one has a perfect crystal ball. But if it is right, even partially right, then the window to understand what is happening is not after the fact. It is right now, while most people are still deciding whether to take it seriously. Go back to that dinner table. The person who laughed in 2019 is still there. The question is, which side of the table you want to be sitting on this time?